cash flow statement. Great. So ladies and gentlemen, here we are. Would want to start straight away by looking at share-based payments. So we have here what we call share-based payments. So share-based payments are under which IFRS? These are under which IFRS? These are under which IFRS? Share-based payment, IFRS 2. So you can start in this case here by scaring the examiner when they ask you a question on this, by scaring the examiner. Of course, not a must, but you can at times scare them. Tell them according to IFRS 2. So for your exams, ladies and gentlemen, of course, we know, ladies and gentlemen, that we have got two types of payments here. Two types of payments here. We can honor, for example, our staff through what year? Issuance of equity instruments, right? You've been with us for say 3 years. So by the time in this case here, you finish your 3rd year and the performance is as good as this, then we shall give you what year? For example, shares in our company, right? At times in this case here, you can tell them, fine, we shall give you some good bonuses here, some good payments, cash payments, but of course pegged on what year? The performance of the shares on the date that you shall be entitled for this particular what year bonus cash, right? Now, for us to understand what I'm talking about this morning, ladies and gentlemen, I would want us to do this quite an easy question. These are straightforward question. These are straightforward question, which is November 2016. It's November 2016. November 2016. Question number 4C. Question number 4C. Question number 4C. As part of its staff motivation program, Better Limited, as part of its staff motivation program, Better Limited decided to grant each of its staff 600 employees 100 options to purchase the company's shares effective from 1 April 2016, 1st April 2016. These options were conditional upon one still being in employment as at 31st March 2020. The following additional details were provided with respect to the scheme. So I have the year there, so 31st March 2017, 31st March 2018, all the way to 31st March 2020. So number of employees expected to terminate or leave employment has been given there. We have fair value of each option. The fair value of the option was 25 as at 1st April 2016. Ladies and gentlemen, listen and listen to me very well. This 1st April 2016 is the grant date. This is the grant date. We were told up here that as part of its staff motivation program, Better Limited decided to grant each of its 600 employees 100 options to purchase the company shares effective from 1st April 2016, right? So this is the grant date. And if this is the grant date, then the fair value at the date of grant, at the grant date, this 25 is very, very important for us. The fair value of the option was 25 as at 1st April 2016 during the grant date. This fair value, if I were you in an exam, I would underline this fair value as at the date of grant. The exercise price of the option will be shillings 12 and the par value of the company's share is shillings 6. The average market price of the share over the 4 years to 31st March 2020 is expected to be 25. So show how Better Limited should report the transactions of the above scheme as per the requirements of IFRS 2 share-based payments over the 4 years. Now listen and listen to me very well. Ladies and gentlemen, here remember, this particular share-based payment, at the end of the day, we shall give these people what? We shall end up giving them options. We are not talking of giving them money. We are not talking of giving them money. We are not talking of giving them cash here. We are giving them options. We are giving them the company's what year? Shares. So this is share-based. And of course, at the end of the day, it's equity instruments we are giving out. If it's equity instruments we are giving out for valuation of their compensation, ladies and gentlemen, we shall only use one fair value throughout. ladies and gentlemen, remember we have got what we call cash-based. I'll be going to cash-based immediately after this, but I'm repeating again that when it comes in this case here to issuance of these like financial instruments to our employees, giving them shares, giving them options, not giving them cash. Remember here, we shall only use the fair value, one fair value, which is the fair value as at the grant date. And we are in agreement that our grant date here is 1st of April when we granted them the right. When we granted them this offer was 1st April 2016. And when we granted them this offer, the fair value of the option was what year 25. Meaning that this column, if I'm the one doing this exam, this column here becomes what year irrelevant. For share-based, when we are issuing equity instruments, fair value doesn't keep on dancing. The fair value doesn't keep on changing. It changes when we have what we call cash-based. When we have what we call cash-based. So if I'm the one doing this, using some red color pen, I'll strike this column off, this fair value of each option. So the moment you've understood that, really everything now is at home. So what do we do here? So what is the vesting period? What is the vesting period in this question? We have grant date and a vesting period. You must wear this vest called RCM Online College for how many years for us to be able to grant you this compensation? What is the vesting period? 4 years, you're right. It's 4 years. You can see they're here, 4 years. 4 years. Great. Now, once I've understood those two things, I've understood the grant date, I've understood the vesting period, then now, ladies and gentlemen, I'm at home. I'll come and write here the year. So we have the year. We have, in this case here, the accumulated expense. The accumulated expense normally goes to the statement of financial position as a liability. Statement of financial position as a liability. And then now we have the annual expense here. We have the annual expense. So this annual expense is what will go to our P and L, is what will go to our P and L, is what will go to our P and L, is what will go to our P and L. So ladies and gentlemen, please give me the years, give me the years, give me the years. So please give me the years here. So if you give me the years, we have here the first year end, year end is 31st March 2017. I don't have to write like the date. I can just write 2017. I can write 2017. I can write there 2018. I can write there 2018. We have 2019. We have 2020 like that. 2020 like that. Now, ladies and gentlemen, listen and listen to me very well. So first of all, before I continue, have you been able to put down this general structure? Have you been able to put down this general structure? Remember, if you have done it in class, you don't have to write. Just open your solution like this, because it's more of discussion. We don't want to get tired, really. Right? Thank you very much. So remember, we started with how many employees? We started with how many employees on the grant date? On the grant date, which was the beginning of 2017, we started with 600, isn't it? 600. But remember, you can only be entitled to this grant, to this award, if you stay with us like forever. We have a vesting period. So like now in year number one, we lost some employees. In year number one, we lost some employees, and Alice Muthia has been able to see the number of employees we lost here. In year number one, you can see we have 25 guys who are going to disappear. So by the end of the year, we are so like much assured that these 25 will not be there. So in this case, you deduct them from our mathematics. Deduct them from so the ones who are left here, then we should be able to give them how many options? We should be able to give them how many options? We should be able to give them 100 options, isn't it? Each one of them multiplied by the fair value as at the grant date. The fair value as at the grant date, fair value as at the grant date, fair value as at the grant date is given here. The fair value as at the grant date is given here as 25. Is given here as 25. Now, ladies and gentlemen, remember, this basically assuming that everything remains the same. Everything remains the same. This will be the compensation that we shall be having. But remember, this is total. For how many years? 4 years. And we have only accounted for how many years now? 1. So then I should be able to acknowledge here my fraction for this year, which will be 1 over what year? The vesting period. 1 over the vesting period. So could you kindly then give me this figure? Could you kindly then give me this figure very fast? So currently I'm being 359, 375. 359, 359, 359, 375. Thank you very much. 375, like that. Great. So we go to 2018. So we go to 2018. Let's go to 2018. So 2018, ladies and gentlemen, 2018, ladies and gentlemen, what do we have in 2018? Very fast. If you look at 2018, we also expect to lose some employees, right? We expect to lose some employees in 2018. We expect to lose 15. So remember, the employees we are bringing forward to 2018 are how many now? The employees we are bringing forward. So 600 minus 25, how many employees are you bringing forward? So at the beginning of 2018, 575. And then we expect some number to disappear. We expect some number to disappear in 2018. We expect some number to disappear in 2018. 15, thank you very much. 15 are disappearing in 2018. So subtract 15 there. So subtract 15 there. So minus 15, yes. Remember now the left employees here, each one of them will be given 100 times. Please disregard all those fair values given there. This is a share-based. This is an equity-based award scheme. So in this case here, times what fair value? Fair value per option. Fair value per option, 25. For equity-based, we shall use 25. Of course, now we are in the second year. So remember, this is accumulated. It's accumulated. So times what here, somebody? We are in our second year out of the total vesting period. So could you then kindly give me this figure for 2018? For 2018, for 2018, they're telling me it is 700,000. It is 700,000. They're telling me it's 700,000, isn't it? 700,000. So can I go in this case, ladies and gentlemen, to year number 3? Can I go to 2019? Can I go to 2019? Can I go to 2019? Yes. So we go to 2019. So 2019, first of all, give me the number of employees brought forward. Give me the number of employees brought forward. They brought forward it to 2019. I'm being told there are 500 what here, somebody? 560, because they have taken 575 minus 15. Minus the number of employees that we shall, ladies and gentlemen, lose in year 3, in 2019. So in 2019, how many employees are we losing here? Remember, ladies and gentlemen, you can only get our award by staying with us. If you disappear, that is it. Here we are losing 10. Even the next day, we shall be losing 10. So minus 10, minus 10, minus 10, minus 10. Now from there, ladies and gentlemen, we know each one of these guys will be left behind. We'll get 100 options, and each option we are strictly sticking with our 25 times. In this case here, this will be, these guys would have done 3 years out of what here, somebody out of 4 years out of the vesting period, right? So ladies and gentlemen, then this gives me what figure, somebody? 1031 to 50. So this gives me 1031 to 50, 1031 to 50. From there we go to the last year. Hooray! 2020. So please give me the number of employees brought forward. Number of employees brought forward, there will be 550. 550 minus, how many shall we be losing in 2020? We said we shall be losing 10. We said we shall be losing 10. So minus 10 multiplied by, in this case here, 100 options per employee times, this is what I love, that we shall strictly go with this 25. Times what here now these guys have been able to vest. So times 4 over 4. 4 over 4 times 1, as somebody is telling me. So what figure are we getting, ladies and gentlemen, here? What figure are we getting here? We have 1350. We have 1350. We have 1350,000. 1350,000. We have 1350,000. Ladies and gentlemen, that is it. So what you need to do is to come and give us the P&L expense. So P&L expense, of course, we are looking at the changes, the increases. So for the first year, 2017, how much do I recognize in the P&L in relation to the share-based payment? Yeah, nothing much really. It's 359. It's 359, 375, 359, 375. Then, ladies and gentlemen, from there, of course, what is the increase here? So that I recognize the increase. So this minus this, what is the increase? What is the increase? 331, 250, 340, 625, 340, 625, 340, 625. From there, we go straight out to the next, we go straight out to the next. So we have here 331, 200, 331, 331, 250. From there, we go to the next, ladies and gentlemen. The increase, remember you're looking at, I know these students, I know what these students are saying. I know what these students are saying. You know, we are looking at the increase from one year to the other. So like now from this to this, what are we getting here, somebody? Is this figure correct? Is this figure correct? Is this figure correct? 340. From there, we have the next increase, the next increase, the next increase, this to this. Could you kindly confirm whether this figure is correct? Kindly confirm whether this figure is correct. This to this, the increase. Lastly, the last increase is what here, somebody? The last increase is what here, somebody? The last increase is 318, 750. 318, 750. So if you do like that, ladies and gentlemen, then automatically you'll have scooped most of the marks. You'll have scooped most of the marks. The last entry there for the debit and the credit, that one, not unless you're so good that you have done it in the past, leave that out. Not unless you're so good and maybe you have done that in the past. The one of debiting, recognizing the money you're going to receive, and then you credit the share capital, you credit the share premium. That is besides our helicopter scooping of what here, the low-hanging fruits. So would you allow Mwalimu to go to the next question? Would you allow Mwalimu to go to the next question? Yes. So I will stop this recording. Great.